If you're looking for an easy way to start creating passive income and get closer to financial freedom, then dividend investing is exactly what you're looking for. Dividend investing can provide safe, reliable, and rapidly growing passive income, which is why it's become the favorite form of passive income for so many people, including myself. In fact, the end goal of my dividend portfolio is to one day be able to live off of my dividend payments. So in this video, I'm going to be revealing 10 dividend stocks that I believe you can hold long term that will help you also one day live off of dividends. This is about building long-term wealth, so it's important to remember that the stocks we invest in aren't necessarily the highest yielding stocks, and they aren't designed to help us get rich quick. If we want to invest into stocks that we can hold long term to live off dividends, we need to look for things like competitive advantages, solid financials, healthy cash flow, industry growth potential, safe and reliable dividend payments, and we of course need to make sure the company is trading at a good value. So let's go ahead and dive into it. The first company on this list is Starbucks. The main reason that I believe Starbucks belongs on this list is because they have a very strong and sustainable competitive advantage. Starbucks has built a powerful brand with global recognition and customer loyalty. If we look at a report recently put out by Starbucks, we can see that in 2022, global comparable store sales increased 8%, driven by a 5% increase in average ticket and 2% increase in comparable transactions. We also saw record global revenue with the highest levels of US average ticket. The China market opened its 6,000th store and received record customer connection scores despite COVID-19 related headwinds. We can also see that there are now more than 58 million Starbucks Rewards members around the world, and in the US, approximately 1 in 10 adults is a Starbucks Rewards member. Now, the company is currently trading at $97.93 per share, and we can see over the past year, the company has seen very nice returns, up around 24%, and that's been solid for the past decade. Over the past 5 years, up 71.3%, and over the last 10 years, up almost 200%. If we dig into the dividend data a little bit, we can see the company currently has a low starting dividend yield of just 2.12%, but it does have a very nice history of increasing its dividends over time. They have seen 12 consecutive years of dividend growth. If we look at the 10-year dividend payout history, again, we can see very solid dividend growth. In 2013, they were paying out 11 cents per share quarterly. Jump forward to now, and that is now 53 cents per share every single quarter. If we look at the dividend yield again, current starting dividend yield of just 2.2%, but if we look at this dividend yield on cost, it tells a much different story. We can see if we invested in this company 10 years ago today, your dividend yield on cost would be sitting at much closer to 7%, which really goes to show the power of investing into dividend growth companies. If we look at the financial statement and dig into the revenues and net income, you can see they have seen massive growth over the past decade on the top and bottom lines. Their revenue has nearly doubled over the past decade, and if we scroll down here, you can see that their net income has nearly doubled as well. Now, if we jump into my stock valuation spreadsheet, which you can download on my Patreon page at the link in the description, you can see we currently have Starbucks plugged in, and depending on what ticker we plug in here, all of this data will automatically load in. But let's keep Starbucks plugged in, and again, one of the things you'll notice is they do have a fairly high payout ratio right now, sitting at around 65.9%. That is a little bit higher than I typically like to see it, but I think for a company like Starbucks, this isn't necessarily a red flag. Analysts currently have a target price of around $115 per share, institutional ownership fairly high at 72.1%, and a beta of 0.96, which is close to 1, meaning you will see the volatility be pretty close to that of the market. Now, we typically look at 4 different valuations like Graham's, discounted cash flow and multiples valuation, and the dividend discount model, but we have a lot to get through, so let's go ahead and quickly run through these. We can see Graham's valuation led to an intrinsic value of just $78 per share. This is due to the high current yield on AAA corporate bonds and lower than expected earnings per share over the last few quarters for Starbucks. But if we look at the discounted cash flow analysis, we come to a much stronger valuation. The multiples valuation pretty good at $93.56, and then the dividend discount model leads to a very high valuation at $129 per share because this company has a great dividend growth rate. So when we jump over to our output tab, we can see our intrinsic value at around $97.60, pretty close to that current trading price for this company. If we were to apply a 10% margin of safety, you could see our acceptable buy price is sitting at around $87.84. Starbucks is actually a company that I own in my personal dividend portfolio and have seen very nice growth from. If I blow this up, you can see I'm currently up around 26.3% on my Starbucks position. Overall, due to Starbucks' scale, its brand recognition, and its customer loyalty, I think this makes it a great option to buy and hold long term. The second stock that we're going to be looking at is Johnson & Johnson. Johnson & Johnson is currently trading at $158.18 per share. It operates within the healthcare industry, offering a diversified portfolio of consumer health products, pharmaceuticals, and medical devices. The company's strong brand reputation, extensive product portfolio, and global distribution network contribute to its competitive advantage. If we come down here, we can see the company has a starting dividend yield of around 3%. So the dividend yield is decent, but there's really two major reasons that people absolutely love this dividend stock. And the first one is it has the highest credit rating that a business can achieve. It's a AAA credit rating. And also, if we jump back over to Seeking Alpha and go to dividends and look at this dividend history, this is a company that has been increasing the amount they pay in dividends for 60 consecutive years. That is absolutely unbelievable. If we go ahead and zoom out, we can see Seeking Alpha starts to track it around 1989, but it was increasing dividends even before that. But look at that steady history of increasing dividends over time. If we look at it over a 10-year period, we can see in 2013, they were paying out 61 cents per share quarterly. Jump forward to now, they're now sitting at $1.19 per share quarterly. If we jump over to my valuation spreadsheet and plug in J&J and hit enter, again, you'll see all this data will load in. Now, one thing we do need to take note of is this payout ratio right here is showing around 93.2%. So let's go ahead and dig into that a little bit. Let's jump back over to Seeking Alpha, which, by the way, you can get at my link in the description. It'll give you a 14-day free trial. But if we click on dividend safety, you can see right here the dividend payout ratio for the trailing 12 months sitting way too high at around 95.8%. So the question is that a red flag? At a first glance, you may think that's the case, but we need to remember that dividends are paid out of free cash flow. And if we come down here and look at the cash flow payout ratio for the trailing 12 months, we can see it's only sitting at 56.63%, meaning that the dividends are much safer than you would originally think. Also, if we look at the non-generally accepted accounting principles dividend payout ratio, it's only sitting at 45, and if we look at the forward-looking dividend payout ratio, it's only sitting at 44%. So yes, this is a little bit of an eye-opener, but really overall, these dividends are very safe for a company that generates as much free cash flow as them. So let's go ahead and look at a couple of valuations real quick. I think for Johnson & Johnson, the only two valuations we really want to look at are going to be the discounted cash flow model and the dividend discount model. Obviously, this company generates massive free cash flow, as I just mentioned. This allows it to invest in research and development, pursue acquisitions, and provide returns to shareholders. And most importantly, like I just mentioned, it allows them to continue to increase the amount they pay in dividends over time. And you can see we came to a discounted cash flow price per share of $170.36. With our dividend discount model, we came to an intrinsic value of $173 because of that consistent track record of increasing dividends. So when we jump over to our output tab, you can see we came to an intrinsic value of around $171.69 with a 10% margin of safety. Our acceptable buy price is sitting at around $154 per share. And if we jump back over to Seeking Alpha, come here to the summary page and look at the past year, we can see there have been opportunities where it's traded in that price range. So now we have 2 out of our 10 dividend stocks, but let's go ahead and look at our third. And this third one is a company that gets a lot of dividend investors excited, and that is Altria Group, stock ticker MO, currently trading at $44.66 per share. Now, the reason this company gets so many dividend investors excited is because of its massive dividend yield, currently sitting at around 8.42%. This is a company that I own in my personal dividend portfolio, and if I blow this chart up a little bit, you can see this company is actually paying me around $228 every single year in dividend income. If we jump back over to Seeking Alpha and go to dividends and look at that dividend history, we can see they have been increasing the amount they pay in dividends for 53 consecutive years. 10 years ago, they were paying out around 44 cents per share quarterly. Jump forward to now, it is now sitting at 94 cents per share quarterly. Let's go ahead and look at those dividend growth rates, and you can see the 3-year dividend growth rate 3.86, the 5-year 7.18, and the 10-year 7.96. So pretty decent dividend growth for a company that has a very high starting dividend yield. Let's go ahead and quickly run through our valuations again. Now on our stock screener page, you'll see the payout ratio is again a little bit of a red flag, showing at 119%. So let's dig into that payout ratio a little bit more once again. Come over here and click on dividend safety. You'll see that dividend payout ratio for trailing 12 months showing around 119%. But if we look at the trailing 12 months non-GAAP, it's sitting at around 76%. And if we look at the forward-looking dividend payout ratio, again, sitting around 76%. Also, if we look at the current cash flow payout ratio, it's sitting at around 84.44%. So yes, those dividend payout ratios are still relatively high, but it's still not nearly as dangerous as that dividend payout ratio for the trailing 12 months would lead you to believe. So for Altria to continue to pay out these high dividends, they do need to continue to hold their dominant market share in the tobacco industry in the United States. So far over the past decade, generating free cash flow has not really been a problem for them due to the strong market position and its pricing power. But again, let's go ahead and jump into our valuations and run through them. With Graham's valuation, I'll go ahead and zoom in a little bit, and you can see we come to an intrinsic value of $58 per share. With our discounted cash flow analysis, you can see I'm projecting a 4% free cash flow growth rate, and we come to an intrinsic value of $62.23 per share. With our multiples valuation, you can see our comparable companies right here. We come to an intrinsic value of $41.80, and with our dividend discount model, you can see I'm projecting a 3% dividend growth rate moving forward. We come to a dividend discount model price per share of $64.55. So when we jump over to our output tab, you can see we come to an intrinsic value of around $56.64. So when I plug in a 10% margin of safety, you can see our acceptable buy price around $50.98, meaning now is a good time to consider adding this company to your portfolio. The fourth company we're going to be looking at is actually one of the largest positions in my personal dividend portfolio, and that is Microsoft, stock ticker MSFT, currently trading at $333.68 per share. This company has seen phenomenal returns over the past few years. We can see year to date, the company is up over 39%, over the past 5 years up 225%, and over the last 10 years up over 870%. Now, unlike Altria Group, they actually have a very low starting dividend yield, only sitting at 0.81%. So why is it included on that list? Well, I'll go ahead and show you why. If we jump over to dividends and look at dividend growth, this company has seen phenomenal dividend growth over the past decade. We can see over the past 3 years, 3-year dividend growth rate of 10%, 5-year dividend growth rate of over 10%, and a 10-year dividend growth rate of 11.57%. If we jump over to the income statement, I'll scroll down, you can see the revenues have exploded over the past decade. I'll scroll down just a little bit further, and you can see the same is true for their net income. Again, if we jump over to my investor toolkit, I'll blow this chart up and you can see Microsoft actually makes up nearly 13% of my entire dividend portfolio. That's because I'm so confident in this stock long term. They have some phenomenal, sustainable, competitive advantages. Microsoft has market-leading software products and services, such as the Windows operating system, its Office productivity suite, and of course their cloud platform. Let's go ahead and jump into our valuations. I'll come up here and plug in Microsoft and hit enter, and you'll see all this data will load in. Now, like I've already mentioned, they do have a very low starting dividend yield, but look at that payout ratio, only sitting at 28.1%, meaning they have plenty of room to continue growing that dividend payout over time, which is exactly what we're looking for with long-term dividend stocks. If we look at Graham's valuation, you can see we actually come to a fairly low intrinsic value of around $234 per share, but with our discounted cash flow model, we come to an intrinsic value of $315 per share because we have a high free cash flow growth rate. With our dividend discount model, you can see we're projecting a very high dividend growth rate of 8.25%, which leads to a high dividend discount model valuation of $392. So when we jump over to our output tab, you can see our 3 valuations, which leads to an intrinsic value of $314 per share. But the company is currently trading at around $333 per share. But it's important to keep in mind that companies like Microsoft are typically going to trade at a premium. It's not very often you get the opportunity to add these types of companies at prices much lower than their intrinsic value. The 5th company we're going to be looking at is actually a little bit different than the previous companies, and that's because we're going to be looking at Realty Income Corporation, stock ticker O. This is a stock that is actually a real estate investment trust. The company focuses on long-term leases with high-quality tenants, primarily in retail and industrial sectors. If we scroll down here on the Realty Income website, we can see some of their client diversification and their top 20 clients. A lot of them are very well-known stores. We have companies like Dollar General, Walgreens, Dollar Tree, we have FedEx, LA Fitness, we have CVS, Walmart and Sam's Club, we have AMC Theaters, Red Lobster, Regal Cinemas, Lowe's, and Kroger, all very well-known and safe tenants. If we jump over to my REIT valuation spreadsheet and plug in the stock ticker O and hit enter, again, this data will load in, and you can see they have a very nice starting dividend yield sitting at 5.1%. Now, the payout ratio is showing 208%, which would tell you immediately that that dividend is not sustainable, but that's actually not true because this is a real estate investment trust. Payout ratio is not the best way to judge the safety of a real estate investment trust payouts. So let's go ahead and jump over to dividend and look at dividend safety. A much better metric to look at when you're looking at the real estate investment trust is going to be the AFFO payout ratio, which we can see right here, and it's sitting at 76.35%, telling us that the dividends from this REIT are currently safe. So let's go ahead and jump back over to our valuations, and I ran it through AFFO multiples. I'll go ahead and zoom in, and we found that it was a little bit undervalued in comparison to some of its peers. We then look at a historical price to FFO valuation, which is typically a way to see how the company has traded historically and where it's at right now. And again, we saw that the company is currently slightly undervalued. Now with our dividend discount model, I'll zoom in just a little bit. You can see we're projecting a growth rate of 3.75% for the future dividends, discount rate of 8, and we come to a dividend discount model price per share of $74.70. So when we jump over to our output tab, we come to an intrinsic value of $69.03. With a 10% margin of safety, you can see our acceptable buy price at around $62.13, meaning now is currently a good time to consider adding this to your portfolio. The sixth company we're going to be looking at is one of my favorite dividend growth companies, and that is Texas Instruments Incorporated, stock ticker TXN, currently trading at $170.36 per share. They have had a phenomenal decade, up around 381%, which is extremely impressive. If we come over here, we can see their starting dividend yield currently sitting pretty close to around 3%. So while I do have a somewhat decent starting dividend yield, it's the dividend growth that makes this company so impressive. If we come down here, click on dividend yield and scroll down a little bit, let's look at the past 10 years. We can see if you invested in them 10 years ago, your dividend yield on cost would be over 14%. That means you'd be getting paid over $140 a year for a one-time $1,000 investment. And that doesn't even include if you reinvested those dividends. Let's go ahead and look at those dividend growth rates. We'll click on dividend growth and scroll down. You can see the 3-year dividend growth rate sitting at 12%, 5-year sitting at 15.6%, and the 10-year sitting at 18.8%. That is absolutely phenomenal dividend growth, and that is exactly what we're looking for in these types of companies. If we jump over to my valuation spreadsheet, again, you can see their payout ratio sitting at around 53.1%, so those dividend payouts are safe. Analysts currently have a target price of around $180 per share, and it has a beta of around 1, so the volatility will follow pretty close to that of the market. If we jump into Graham's valuation and zoom in, you can see we come to an intrinsic value of around $158.40. With our discounted cash flow analysis, we come to a very strong valuation with a DCF price per share of $192. With our dividend discount model, you can see we came to an intrinsic value of $211, and with our multiples valuation, we came to an intrinsic value of $192 per share. So when we jump over to our output tab, we can see our 4 valuations, average them together, and we come to an intrinsic value of $188.69. So with a 10% margin of safety, you can see our acceptable buy price currently sitting at around $170 per share, very close to that current trading price for this company. The 7th company we're going to be looking at has a very rich history of increasing the amount it pays in dividends year over year, and that is Lowe's, stock ticker LOW, currently trading at $207.16. This is again a company that has seen phenomenal returns over the past 10 years, up over 406%. The company has a decent starting dividend yield sitting at around 2.13%, but let's look at that dividend history. We can see this is a company that has been increasing the amount it pays in dividends for 59 consecutive years. 10 years ago, they were paying out around 16 cents per share quarterly, and now that is sitting at $1.10 per share every single quarter. Let's look at that dividend growth. We can see their 3-year dividend growth rate unbelievably high at 24%, 5-year at 20%, and the 10-year at 20%. This company has grown its dividend more than almost any company in the S&P 500. If we jump over to our valuation spreadsheet, you can see the payout ratio currently nice and low, sitting at around 30.6%, and analysts currently have a target price of around $230 per share. Let's look at that discounted cash flow valuation. I'll zoom in just a little bit, and you can see we're projecting solid free cash flow growth moving forward, 8.5%, and that leads to a discounted cash flow analysis price per share of $257. If we look at that dividend discount model, again, you can see we're projecting a 7.5% dividend growth rate. Pretty nice. With a discount rate of 9%, we come to a dividend discount model price per share of $301. So when we jump over to our output tab, we have 4 different valuations. We only looked at 2 of them in this scenario. The other 2 are drawing it down just a little bit, but we still come to an intrinsic value of $233.54. So with a 10% margin of safety, you can see our acceptable buy price for this company is sitting at around $210 per share, meaning now may be a good time to consider adding this to your portfolio. The 8th company we're going to be looking at is, in my opinion, one of the healthiest companies that I've evaluated in a very long time, and that is Visa, stock ticker V, currently trading at $228.50. $133.22 per share. Let's jump into the financials and I'll show you why this is such a healthy company. The first thing I will point out is yes, we've seen phenomenal revenue growth and we've also seen phenomenal net income growth. But if we jump over here and click on profitability, look at their gross profit margins for the trailing 12 months. 97.68%. That is absolutely unbelievable. And in my opinion, that gives them a huge competitive advantage. Now, we do need to point out the company has a very low starting dividend yield, currently sitting right at around 0.8, but they've also seen very good dividend growth over the past decade, like most of the companies that we've seen. They have a 3-year dividend growth rate of 14.4%, 5-year of 17.2%, and a 10-year dividend growth rate of nearly 20%, sitting at 19%. So again, a very great dividend growth company. Let's go ahead and jump into my valuation spreadsheet. And this one's a little bit different because this is actually a financial stock, but we'll keep moving forward. Again, dividend yield of 0.79%, nice low payout ratio of only 22%. So they have plenty of room to continue to grow those dividends over time. If we look at Graham's valuation, we come to an intrinsic value of around $190 per share. If we look at that multiples valuation, I'll zoom in just a little bit, we come to an intrinsic value of $266. And with our dividend discount model, I'm projecting a very high dividend growth rate of 7.75%. And we come to an intrinsic value of $258.60. So when we jump over to our output tab, you can see we come to an intrinsic value of $238.25 with a 10% margin of safety. Our acceptable buy price sitting at around $214, so it is pretty close to trading at its intrinsic value, it would appear. The ninth company that we're looking at is another financial stock, this time a bank stock, and that is JP Morgan Chase & Co., stock ticker JP Morgan, currently trading at $139.34 per share. This company has a starting dividend yield currently sitting at around 2.88%. If we jump over to dividends and look at that dividend history, we can see they've been increasing dividends for the last 8 years. We'll go ahead and scroll out and you can see those dividend payouts have jumped up quite a bit. It was 30 cents per share in 2013. And it is now currently sitting at $1 per share every single quarter. If we jump into my valuation spreadsheet, one of the things you'll notice is that payout ratio is only sitting at 29.5%, so they have plenty of room to continue to grow those dividend payouts over time. If we jump into Graham's valuation, I'll zoom in just a little bit, you can see we come to an intrinsic value of around $133 per share, even with a fairly low growth rate projection. When we look at the historical price to tangible book value, again, we'll note the company seems to be trading at around fair value. With our multiples valuation, you can see our comparable companies right here. We come to an intrinsic value of $139.62. And with our dividend discount model, we have a dividend growth rate of around 6% for this company, which gives us a dividend discount model price per share of $169.60. So when we jump over to our output tab, you can see our 4 valuations that we used. We come to an intrinsic value of $147.67, a little bit higher than that current trading price, but with a 10% margin of safety. You can see our acceptable buy price currently sitting at around $132.90. If we jump over to Seeking Alpha, you'll see there's been plenty of opportunities within the past year to buy in that range, which is exactly what I did with my personal dividend portfolio. And finally, the last company that we're going to be looking at is none other than Target Corporation, stock ticker TGT, currently trading at $132.70 per share. Now, over the past year, they're actually down quite a bit, down almost 7%. And we can see earlier in 2021, they were actually trading as high as around $260 per share, so their share price has come down quite a bit. Now, this lower trading price has given them a pretty solid starting dividend yield, currently sitting at around 3.31%. If we jump over and look at that dividend history, we can see they've been increasing dividend payouts for 54 consecutive years. And if we look at their dividend growth rates again, it's been very solid for this company. Over the past 3 years, 17.8%, past 5 years, 11.7%, and over the past 10 years, 11.6%. Let's go ahead and jump into our valuations. One of the things you'll notice again, payout ratio a little bit higher than I'd like to see it at around 70.1%. But if we dig into this a little bit more, I'll come over here to dividend safety again. What you'll notice is that dividend cash flow payout ratio only sitting at 26.22%, meaning they easily generate enough free cash flow to continue to pay out those dividends and increase it year over year. So if we go through our valuations, I'll go ahead and zoom in on Grams. You'll see we come to an intrinsic value of $129.24 per share. With our discounted cash flow analysis, we project a 8% free cash flow growth rate, and this gives us a discounted cash flow price per share of $197. With our multiples valuation, you can see the comparable companies we're using right here. but we come to an intrinsic value of only $128 per share. But with our dividend discount model, again, this company has seen really good dividend growth over the last couple of years. We're projecting a dividend growth rate of 6.25%, which gives us a dividend discount model price per share of $204. So when we jump over to our output tab, we come to an intrinsic value of $164.64. With a 10% margin of safety, our acceptable buy price is sitting at $148.18, meaning now could be a good time to consider adding this company to your portfolio. So there you go. Those are 10 dividend stocks that I believe you can hold long term and will help you one day be able to live off of dividend income. If you'd like to be able to download this spreadsheet, you can head over to my Patreon page at the link in the description. Seeking Alpha is also offering a 14-day free trial at my link in the description, so be sure to check that out. Thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.